So welcome everybody, wherever you are in the world. So good morning, good afternoon, good evening. I think we've got people from all over the place. So thank you very much for taking time out of your schedules to join. My name is Richard Bradstock. I'm the Managing Director here at RPA Group. We're joined by, bear with me one second, I'm on the wrong thing. Here we go. We are joined by George Radford, co-founder and MD as well of the RPA Group, and Nick Harvey-Jones, Managing Director of King's Crescent Homes, live from the golf course. But we're here today, obviously, I presume everybody has read the invite, so this is probably a redundant slide. But we're here today to talk a little bit about UK property. And I think it's fair to say, guys, that it's been a pretty lively few days in many ways around not just property, but the economy and the UK in general. We've got a new Prime Minister, new Chancellor, a new budget, new things going on all over the place. So obviously there's quite a lot for us to cover. The main point that we're obviously interested in addressing here is, with the UK property market, does it still work? We've got a higher interest rate environment, we've got an inflationary environment. Is it still a viable investment opportunity? And on a basic level, is it still something that people should be doing? We're also going to have a look at some of the strategies to answer that question, and then finish off by talking a little bit about the new RPA Group's new launch, the Goldstone Apartments in Hove, which, as you may have guessed, is a King's Crescent Homes development, which is why Nick's on the call. And so without further ado, I think we should just launch into it. So Nick, I think just a good place to start. Can you perhaps just start off by telling us a little bit about yourself and your background and how you've sort of come to developing and so on and so forth?
Yeah, no problem. I own King's Crescent Homes. I set it up probably 4 or so years ago, but before that I was running, I was sort of in the funds management space, well over £1 billion worth of property in the UK, which was a mix of a student housing fund and a mixed-use residential and commercial fund, right. Which targeted properties UK-wide. I then set up my own company. Those funds had quite a lot of development exposure, so development and structured finance was always something that was my preference as far as strategies in development, and residential, obviously, I think is the safest place to be opportunistic. If that's a fair way of putting things. Yeah. So we set up the development company 4 years ago, and we started with a small site in Rugby. I assume that the reception's okay. Sorry, Richard, did you?
Yeah, we can. Yeah, we can. I can certainly hear you. Yeah.
Okay. Great. If there's an issue, just shout. But since setting up, we started with a small site in Rugby, which was only 21 units, and we've built quite quickly in the last 4 years up to a company where we're delivering roughly, give or take, 1,000 units at the moment, from Birmingham right down south to Hove, and with a few developments scattered in the middle in Ashford, London, and other areas. So we've grown quite quickly. We've learned a lot. We always target developments which have, we like developments near major train stations. So far, we've been doing commuter belt sort of areas of London. I even describe Birmingham as a commuter belt, simply because HS2 bringing in, making it a commuter belt city. And yeah, things have been going very well since, apart from the fact that we've had COVID, Brexit, and Ukraine in the meantime. So,
yeah, exactly.
We've had the world against us. Yeah.
Yeah, it's been. I mean, obviously, RPA's journey has been really alongside yours in many ways. We're amazingly almost 3 years old now as a company, and obviously we've been working with you pretty much right from the start. I mean, we'll come back to a little bit later, because we'll come back to the sort of your track record and what you've built, because what I do want to highlight at the end of this, towards the end of this webinar, the Copperworks in particular, which is obviously your flagship site that we worked on 2 years ago now, which is obviously completing and handing over, and it's a great example of how the process should work and can work, and how it works for investors, with the numbers that they're achieving with rental yields and that sort of thing. So we'll come back to that. George, I mean, just to sort of bring you in, I mean, perhaps you can give us a short synopsis of I suppose what we're seeing as of today in the market.
Yeah, sure. I mean, since the webinar invite went out, as you said, it's been quite a lot of activity, a new monarch in there as well. So there's definitely some headwinds currently, and not just in the UK, across the globe. And inflation clearly is sort of one of the main challenges for the global economy. We're seeing central banks, aren't we, trying to control that. Some more successfully than others. So inflation's definitely got its downsides, but there are upsides as well, and I'm sure Nick can elaborate on that in terms of some of the squeeze it will put on supply in the property market in due course. But yeah, inflation's definitely a challenge, and I mean, you probably saw this morning the IMF is a big fan of the UK government, so lots of confidence in them. Quasi's policies are not necessarily being well received around the globe, but I think we'll talk about it in a minute. They are actually quite positive for buy-to-let investors, bizarrely.
Yeah, there are opportunities associated with that, aren't there? Of course.
Yeah, exactly. But look, it's all relative, I think, and people can think inflation's all doom and gloom and it's UK specific, but it's not. It's a problem for the world, and what do governments expect, really? This is not just an aftermath of the Ukraine war that's ongoing. You stop people from going to work for over a year with COVID, and this is kind of what happens, isn't it?
I think it's also interesting, though, isn't it, that and I suspect this is a theme we're going to come back to again and again over the next sort of 20 minutes or so. Property is traditionally a hedge against inflation. And we'll see that a bit later on when we talk about the rental market and how that's performed, and it comes down to, in the end, like, what are you investing in that's actually going to give you those sort of positive returns? And property traditionally in times like this is something that people buy because it's real and tangible. And even if values decrease, you're still getting an income. And actually those incomes are going up because rents are appreciating rapidly. But maybe perhaps you could expand a little bit on the budget, what that means for the property market.
Yeah, and I think the most fundamental thing is the reduction in stamp duty. So whoever you are buying, whether it's a buy-to-let investor, a first-time buyer, there are benefits. So if you're buying a property, you can see in the chart down the bottom there, say £250,000, even if it's a second home, third home, you're still going to save £2,500 on a £250,000 purchase. And obviously, if you're a first-time buyer, the savings are significant. So that's a really good boost for the property market. Corporation tax, I know more and more people are holding properties, aren't they, within companies, especially multiple landlords. Multiple property landlords, and they've capped that now at 19% instead of increasing it to 25%. So that's actually been welcome news in the property world. And then the basic rate income tax as well. It's been reduced slightly, and then the higher rate has been scrapped, which is good for a lot of people earning higher money, but again, not overly well received by the markets. But overall, I would say that the budget has been favourable for for property investors.
Yeah, absolutely, 100%. I mean, Nick, at this point, if we talk about the property market sort of as a whole, I mean, from your side as a developer, how does this affect you, or how, you know, and for any developer out there looking to build something, what are the challenges that you're facing at the moment?
Yeah, I mean, the budget's the budget, and you know, if I'm comparing to America, where interest rates are going up far higher and far quicker, you know, UK is in a good spot from that perspective. The tax is tax, and obviously lower taxes are going to be good for holding assets like property in their vehicles and being taxed lower. So that, but I don't think they're the big drivers. For me, the big drivers are still the Ukraine is causing a really tight, much tighter supply from a developer perspective, just because making schemes viable with build cost inflation going up. It's, you know, it's a tight market, and all of the markets that we're in are tight. You know, the demand for housing is much higher than supply. Yeah. We're seeing that in rental growth, which frankly, rental growth is just awesome. And it's astonishing in most places. Yeah. Especially major areas where people want to live, which is fundamentally where we are. So yeah, it's a tight supply, and it's getting tighter because the UK, they still need to build homes. Sale affordability is tested with the interest rate rises, and therefore it falls into, you know, the rental audience is bigger and bigger. The private rented sector is the biggest growth market of institutional real estate, and therefore, you know, the institutions are going to start driving rental growth just as much as buy-to-let individual owners. So, you know, as you said before, the buy-to-let audience is it's quite a strong market at the moment, and with rental going the way it's going, I think we'll just get stronger.
I think so, because, you know, I mean, it's such a basic thing, but it is something that people miss sometimes when they think about property, that at the end of the day, it's all driven by the supply and demand imbalance. And when we have a market that, it's performed exceptionally well over the last 2 or 3 years. You know, really since that first lockdown, it's where it had a bit of a blip. It's been doing exceptionally well, and the rents, again, there've been one or two sort of different trend. You know, there's been a trend of people moving out of sort of smaller flats in central London and looking for a bit more space and commuter belt locations, which is something obviously that we've done, you know, that we've offered our clients through you, Nick, of course, with places like Ashford, and now again, obviously with Brighton, there's another commuter belt location. But we are seeing, you know, these rental numbers are staggering. I mean, we'll come back to it in a minute, but I think just on the on the Brighton development, the Hove development that we're going to be talking about in a little bit. You know, the first time I saw rental quotes from your side, and we were one beds were quoted at about £1,300 a square foot, and sort of 6 months later they're being quoted at £1,700 a square foot. So perhaps they were a bit low to start with, but the point is that it demonstrates that in markets where there is a lack of supply and a real demand for that property, in the end, there's going to be enough percentage income, right, to protect you against these mortgage rates. I mean, George, I know mortgage rates are something that we were talking about earlier. Perhaps you want to talk a little bit about those.
Yeah, definitely. I mean, just to add to what you're saying there, you know, on the capital growth side as well, we've seen double-digit growth, haven't we, over the last 2 years per year. Yeah. You know, off the back of COVID and off the back of Brexit, and the UK market has remained remarkably resilient, and it's also got to be sustainable. It can't go up by double digit every year, you know. So I think moving forward it will continue to be very stable, but it will just taper off from a growth perspective, because as Nick said, the supply side is and will continue to become more constrained, but yet demand is incredibly high. On the mortgage side, I mean, it's who knows what's going on there over the next few days, because, you know, on the ground here, you know, some lenders, you know, they're sort of reviewing their products, aren't they, massively, and sort of putting them on hold for a few days, because they just need some clarity from the Bank of England and from the government. So, but that being said, there's still some really good rates there. I mean, as of this morning, as you know, you can still get a 4.6%, tracker on a 65% mortgage, 70% mortgage if you're based more over your way than in Africa, and you can get a 5-year fix just over 5%. So, and a lot of our clients are, taking interest-only mortgages and not principal repayment mortgages. So these increased rates, obviously, they're not ideal, but the monthly annual repayments are not as significant as one might think if you are doing an interest-only base as well. So there's still some good products out there.
Yeah, I mean, and I think it's also worth noting, I mean, Nick, you'll obviously remember pre-GFC, the sort of base rates coming down. I mean, the base rate pre-GFC was about 4% from memory. And all that we saw back then was that actually, the banks have been having a fine old time of it recently by achieving quite significant margins on their lending. Whereas actually, I think because they still need to lend, people still want to buy. I suspect what we'll see is a trimming of those margins rather than making 3% above base or whatever it might be. Because back in pre-2007, it was still possible to get 5-6% rates above a 4% base. So I think that's something that we'll see, I suspect. I think obviously the whole point about this webinar was to try and provide a little bit of clarity and around certainly our thinking at RPA about how we feel people should be approaching buy-to-let property, because I mean we haven't really talked about the pound. I mean most of the countries I suspect that are on this call right now, a large part of them in terms of where you're calling from and the money people are actually earning, and a large part of them are going to be US dollar based, right? Or pegged in some way, across the Middle East, or to the US dollar. So there is an obvious opportunity, and which is why we are still, despite this sort of these perceived headwinds or these headwinds, that there is still a significant opportunity. On a very basic level, actually I worked out this morning, given at the rate that I looked on XE.com this morning, it's almost a 23% discount from May last year if you're a US dollar based buyer. But again, for me, there is, again, to mitigate these higher interest rates, obviously a higher yield opportunity will always be something that people look for. And again, this is something, again, that, on this call, we'll be discussing with Nick and the developments that we're working on with him. Stamp duty cuts, George has already mentioned. But the big thing for me is that sort of rarity value. That, I mean, Nick, at this point, using Brighton and Hove as an example, and I'll come back to that sort of what I mean by rarity in a second, but perhaps you could tell us a little bit about why you like Brighton and Hove, and why in this sort of market today you feel that this is something that works for you and for people buying into it.
Yeah, I mean, being very fundamental, Brighton and Hove, if you look on lists, best places to live in the UK, Brighton, and best places to be in the UK and go out in the UK, Brighton and Hove is usually in top 5 of all lists. So it's a fundamentally good place to live, and Hove is seen as a slightly upmarkety part of that Brighton and Hove area. We obviously build everything extremely close to major train stations, and this is no different. We're, I think, 2-minute walk from Hove Station, which is definitely a commuter belt town of London, travelling in from multiple train stations as well. So you've got I think 3 major train stations in London goes to Hove Station or Brighton Station. So that's a huge tick in the box. Just from a supply-demand perspective, this is something that you won't read in the papers, but Brighton and Hove, there's not actually that much development because supply is extremely tight. There in Hove itself, the other major developments there are both for private rented sector institutions. Therefore, they are not being made available for private investors. And in those developments, there's a few hundred units, but that is the bulk of the supply and the competition to effectively us. The other ones are literally seafront developments or literally just back from the seafront. So they're not really comparable.
So much more expensive, right? Much more expensive down.
Yeah, much more expensive, literally, if on the seafront. So wherever there's institutions, and the private rented sector market, which is driven by institutional investment, that usually drives rental growth, and it also will drive capital growth because institutions tend to look after their stock better than your average buy-to-let investor. No offense to buy-to-let investors, but that's basically the truth of it. That institutions tend to put on them by tenants. There's a lot of brands. They tend to look after their properties, and therefore value and rental growth is more apparent in them. So I think the competition, the rarity, as you say before, our site it's one of a very few, and the competition is really not direct. The other thing is that COVID has produced, it's produced problems in I suppose lifestyle and fundamentally the way people live, but it's also produced positive changes, like people are not living necessarily in places like London city centre. They're living an hour away because they don't have to be in their office all the time. So I think Brighton and Hove and our other sites, all of our sites are in line with that sort of way of thinking, that they're very close to London, but not in London city centre.
Yeah, absolutely. Well, I mean, certainly as far as Hove's concerned, who doesn't want to live beside the sea, right? It's
exactly.
on a very basic level. What with this particular site, something that I found quite interesting when I was down there, and you can sort of see this when you look at Google Maps again, which sort of, and it demonstrates that sort of that lack of supply, that rarity factor, is the fact that virtually all of Hove is houses, right? There's very little in that sort of in apartments. And when you look down in Brighton, for example, in the sort of Brighton city centre, where there are a few more apartments, but then the prices are so much more. It's quite an interesting sort of little pocket of regeneration that's going on there.
Yeah. It specifically is a regeneration area. I think it's called the Sackville Regeneration Area. But so it's it's perfect. It's well located. It's got amenities right next door. Shopping centre. It's got a retail park literally up the backs onto it. So there's many reasons why it's a good regen area. And as I said before, the other parts of that regen area are institutions running private rented sector buildings. Of apartments, but other than that, you're right. It's usually older second-hand housing stuff, or it's 30 or so apartments nearer to much close, right on the sea, sort of thing, which are a different,
absolutely,
sort of resident.
I mean, I think the other thing as well, George, just from our perspective, that sort of final point there, and obviously we've got Nick on the call, so we can talk about him for a second. But working with the right developer from our point of view is absolutely key, because that sort of particularly in a market that we're in at the moment, where you do have to make sure that you are buying the right thing for the right price, and in a market that will rent and so on. I mean, can you talk a little bit about that, George, from our perspective as an agent, the value of working with someone like Nick?
Well, it's paramount, isn't it, really? Because you live and die by your sword. And you've got to make sure you're working with the best in market and developers that are well capitalized with a strong track record. Because we need completed products, don't we, in the right locations for our clients to make money, and that's the crux of the matter. And Nick and all of our other partners are exactly of that help. So, and I think the slightly more challenging environment that we're moving into, it does create opportunity, and that the weaker developers and those that maybe shouldn't be building, they will be forced out of the market. So
the smile there on Nick's face, absolutely.
There's quite of them already being forced out, George.
Yes, exactly. And this is just the start of it, I think.
Yeah, exactly. So Yeah, no, absolutely. I mean, just to add to, I mean, just for the benefit of the audience, as it were, I think it's probably worth just, for those that don't know Brighton well, you know, there are some key facts there. So one thing that surprised me actually when I first started looking into it is the population. I mean, it's almost as big as Manchester. Manchester's about 500,000 people. You know, Brighton's 474,000. Whereas I think that's sort of 3 or 4 years old now. But the point being is that it's a significant city, UK city in its own right. It's not just your little seaside town. It's a proper, you know, a proper location, if you like, and is home to some really big names: American Express, Bupa, Legal & General, etc., etc. A couple of big universities, 40,000 students. Brighton College, one of the best schools in the country, and a couple of quite interesting stats there around the sort of the tourist economy, if you like. So 12 million visitors a year, 1.67 million overnight stays. I mean, these are massive numbers. And as Nick, as you said just now, like, it is regularly in the top 5 for this or top 5 for that in terms of living, and you know, and it's one of the, I mean, it is the most popular tourist destination on the south coast in terms of visitors. So yeah, it's a significant economy in its own right, and a wealthy one. You know, these are, you know, the people who are renting. I mentioned just now, you know, a 1-bed renting at £1,700 for the month. I mean, you have to be doing well to be renting those numbers. This is not buying in, you know, a sort of a slightly more gritty up and coming area. This is a very established, very in demand location, if you like. I mean, to be fair, people have been moving to Brighton from London, you know, for forever. It's always been that's sort of one of the most established destinations for people moving out of London. And I think I saw a stat that in 2021, something like 30% of all new transactions in Brighton were people moving from London. So pretty significant. An hour from London, as I think has already been said. And that kind of rarity, scarcity, lack of supply value, and its popularity is shown by the fact that over the last 20 years, it has outperformed the UK average and London. So I mean, this is a hell of an accolade for what is, you know, an amazing city. So with the development itself, Nick, I mean, do you mind giving us a little bit of background about the actual site and what it is?
Yeah, I mean, it is what you see there. It's an attractively designed apartment block. King's Crescent Homes is a company.
Have we lost Nick?
Sounds like probably a bit of a cop out, but
Nick, sorry. Sorry, we lost you there briefly, just as you got into full flow. Do you mind starting again?
Can you hear me now?
Yeah. Yes, we can.
Yeah. As a company, and so far we've tended to steer away from development sites where they look and feel extremely difficult, if that's fair. The way this comes from building regulations and, you know, fire and things like that these days has got quite difficult. So we tend to, the Goldstone Apartments, the A block is 11 floors, and that's pretty much as high as we'll really go, because it's a comfortable level from a construction and delivery perspective. And then you've got B block and C block, which are lower height and around that. It's an attractively, there's a lot of green and landscape space around it, and there's also a lot of rooftop space. I mean, I don't know if anybody on the call or the webinar knows of our Ashford scheme, but it's extremely similar in that there's 3 blocks. There's an undercroft car park. The car park is extremely attractive for Brighton and Hove, because getting a car park in Brighton and Hove is very difficult. So, you know, here we've got over 100 car spaces available for buyers, which is a big tick in the box. It's right next to amenities, which is always a massive tick in our box. So, you know, every company goes by.
Oh, have we lost Nick again? Can you hear him, George?
No.
Nick, I don't know whether you can hear us, but we've lost you. So perhaps we'll we'll come back to Nick there in a second. George, maybe you could talk a little bit about, obviously Nick's already mentioned that kind of the change in way people are operating their work lives and so on. And obviously this development has quite a bit that feeds into that. So perhaps you could expand on that.
Yeah, absolutely. I mean, people are looking for a nicer environment, aren't they, in their home, and they still want to be close to transport links for obvious reasons. They still need to invariably get into London because it is still the beating heart of the UK economy. But they're working from home far more, and they need their home to often double up. And you know, the communal areas like you're showing here, the co-working space within the building is a massive selling point. All of the units having balconies, again, you know, it's a massive selling point. Great connectivity within the building. You know, instead of the internet crashing, just connectivity is key.
Yeah.
You know, simple stuff, but it's really, really important. And this development is perfectly designed and very much in tune with what people are looking for.
I mean, actually, you know yourself, don't you, with a little boy that working from home as well. Even if you are working from home, to actually have that additional space of a co-working space is invaluable.
Yeah, definitely.
You can't have children knocking in every 5 minutes.
It doesn't always work, does it?
No.
And then obviously, as I mentioned, the communal areas, the communal roof gardens, as well as the proximity to the transport links, as I said, and all the amenities around here.
Yeah.
And you've got the playing fields, haven't you, just behind?
Yeah.
Beautiful playing fields, Hove playing fields.
You've got for anyone that likes cricket, you've got the county ground just down the road.
Yeah, you've got Brighton Hove Football Club.
Yeah.
If you want to go and watch Man U play when they come and visit.
Yeah, absolutely. So I mean, I think at this point,
great development that's obviously been very well received by the market.
Yeah, absolutely. And I think at this point, it's probably worth highlighting why it's been well received. And because obviously we set out, here comes Nick. Hi, Nick, are you back?
Hello. You won't believe this, but my phone overheated and crashed.
Oh, right.
Now, apologies.
No worries. We'll come back to what you were saying in a second. You were waxing lyrical, I think, but we lost you at the crucial moment. We
can't believe that happened. Sorry.
Don't worry. We've just been talking a little bit. George has just been talking a little bit about the sort of the co-working space, the communal areas, and so we've just moved on to why we set out in this webinar to try and answer or give people at least some idea of why we at RPA, and obviously yourself, Nick, believe that actually this is still something that works. Buy to let property in the UK still works as an investment angle. And I think there's a couple of things here on the screen as to to answer that question. When we're talking about, obviously the big unknown here literally today is probably the interest rates, right? Which, as we saw from the slide earlier when you were talking, George, they kind of range from 3.99 to 6.5, and it's and quite honestly, those numbers will probably change again by next week. So we've already mentioned that property is a hedge against inflation traditionally, and that's very much the case here, because in the same sort of period of the last year or two, we've seen rents rise to a point where within this particular development, on the standard AST lets, the long lets, the sort of 2-year lets which are obviously the sort of the standard route in the buy-to-let market, some of these units are well over 6% in terms of gross yields. So that ultimately covers, that will cover your costs on a monthly basis. And then on the short lets model, actually, we're talking net yields of even higher than that, up to 7.7%. So George, maybe, expand a little bit about the short let side of things.
Yeah, I mean, quite simply, it's an absolutely booming market, isn't it? And there's no better place for it, arguably outside of London, than Brighton and home. Yeah. And look, I like both of you travel quite a lot for work, and I get a bit sick and tired of always being in a hotel. Yeah. And if you're going away for 5 days, you'd rather have an apartment. I would. You control your diet. You cook what you want to cook. You don't have to make small talk with people that aren't conducive to business. I'm not trying to be
very social of you, George.
But no. But sometimes you want some privacy, and you don't want to be interrupted. You want to get stuff done, and you want your own space and home away from home. And that, quite simply for me, is where the short-term let market, has so much strength. Because
it's worth. I mean, Nick, I'm sure you've stayed down in Brighton quite a lot recently, but the hotel rates are scandalous, quite frankly. They are. Exactly. It's so expensive for a pretty average hotel room. So, where are we? So I think as well, just to highlight the USD opportunity, the US dollar pound opportunity, or more accurately, the weakness of the pound, I should say. So we were just running some numbers just before this, and it's quite astonishing, to be honest. We've got, this is a third floor, one bed, £384,950, a 20% exchange deposit of 77,240. Today, as of 3:30, when I checked the exchange rates, that was equating to $81,000, when literally a year ago today, that was $105,000. So for any of us earning in dirhams or dollars or reals, whatever it might be, that is linked to or holding dollars is linked to the pound, there is a significant saving there. And across the whole 35% deposit and costs, we're talking about $45,000 saving. So there is an opportunity there to get into the market and take advantage of that. Just as well, I won't go through this line by line, but just to highlight the fact that exactly what I said just now, using a mortgage or having a mortgage at 65% LTV, the figures on the left, and we can share these slides after this, the figures on the left essentially show, with an income of £1,800 or a gross yield of 5.6% on a long-term let, you're effectively breaking even, £55 negative. So it's neither here nor there. And over, as I think, Nick, the lettings, the agency actually said to you guys that we need to get these requoted in 3 months' time because they think they'll have gone up, right? It's you're muted, by the way. Just
that's a general statement coming from multiple agents. So.
Yeah, which is staggering, really, just how fast it's moving, quite honestly. And with the lack of supply, it's only going to keep going. And then on the right-hand side, with the short lets opportunity, an average of £167 a night with 80% occupancy, which is probably reasonably conservative across the year. On the same loan of 5.5%, 65% of the value at 5.5%, you've got a projected net cash position of £1,200. I mean, it's excellent, quite frankly. And and whereas perhaps it might have been even more excellent 3 months ago when the rates were a little bit lower, it still demonstrates that it works. Absolutely. George, anything to add on that?
All I would add is that, if you look at the overall return then, net return, that's based on the purchase price. If you actually start looking at even a bit deeper, the return on the equity that you've invested into the property, that 35%, they go up even higher. And that's often the point that can be missed.
Yeah, absolutely. So just sort of, just following this, I do want to talk a little bit, Nick, about your previous track record and just show a few photos, because I think it's important to, particularly for Copperworks, I think it's important to demonstrate in this world that is volatile that that these things are getting built and they're being built well. But just to round off Goldstone, it's 999 years leasehold, 20% deposit on exchange now. Prices from 362,450. I believe that unit's actually reserved, but there are still units near that price. And yeah, so I think George we launched a couple of weeks ago. Sales, it's moving well, and I think it's worth adding that if this isn't right for you, sort of as a potential investor, someone listening to us sort of waffling on here, there are alternative options, particularly in somewhere like Birmingham, where we have two developments with Nick that we are currently working on. And just to bring attention to that, because I mean, they look absolutely amazing. I mean, George, you were there the other day, but Nick, can you tell us a little bit about the Copperworks? Just because, again, I think it's important to demonstrate that ultimately these things are being delivered, and they very much are.
Yeah, I mean, the Copperworks, we bought that at the beginning of COVID, really. We bought it on Valentine's Day 2020, and then COVID shut everything down a couple of weeks later. So we've seen all the difficulties of the market, and it has made things hard to deliver. There's no doubt about it. But Copperworks is a mix of a listed heritage sort of building development next to new builds. So it all looks very classic. Like I was saying before, we tend to avoid too much height and too much difficulty from a delivery point of view. The jewellery quarter happens to be 4 stories as an average height maximum anyway. And that site we got planning for a few more units, but it's now about 160 units, where the first phase of 72 units has just been, most of it's now completed. Most of it is sold out, as you know, Richard, because you sold a lot of them. But we have got the tail end left, and we're starting phase 2 in the next few months on that, which is exciting. It's daunting, obviously, because the market is what the market is, but it gives you an idea that we are keeping on going. And capital growth and rental growth in Birmingham, just like all our other sites, has gone very well. So it's still got all the same. You can get caught up in the white noise of what's going on, but interest rates will, in my view, inevitably go up and then probably drop back down, because frankly the world's got used to low interest rates, and I don't think the world's ready for like things like they used to be. Birmingham's got amazing infrastructure projects going on, which will make it a commuter belt town of London. And what you read in the papers about the amount of supply in Birmingham, I wouldn't be surprised if a lot of that supply doesn't get brought forward, simply because it's a lot of high buildings, which the higher you go, the more expensive to build, and the less viable things will be. And I'm already aware of quite a few sites which will not go forward as planned, certainly not yet like they were. So again, there's micro reasons for tight supply.
I think also, like, it's worth highlighting just here again, rarity is something, or scarcity of opportunity, both to build and to buy in and to rent in. Therefore, it's exactly the same with the Copperworks and Scholars Quarter, which is the newer site that we're working on next door to Copperworks. The jewellery quarter is a restricted area or conservation area, so effectively there is a limit on what is possible to build. And again, given its sort of status as probably the best location in central Birmingham, if you want to live within a few minutes walk of the city centre, that's probably the location you want to live in. And we've seen that with these rents that we were quoting £825 for an average 1-bed 2 years ago. And location-wise, it's quite a small area from a horizontal direction, but vertically they won't go up above 4. You might be lucky to have a 5-story building, but so if it doesn't go up and it doesn't go out, your supply is obviously restricted in a big way. No, absolutely, and that's driving those prices. Got a question actually, which come in from an anonymous attendee, very mysterious. If with costs going up and all the rest of it, around or inflation and construction costs, and therefore, so if someone was to exchange on a unit off plan on Hove, for example, the question is, can you as a developer increase the price after they bought the property off plan, effectively?
Sorry, can we increase the price to the buyer?
So say a buyer buys that unit at 382 grand, he exchanges contracts. The question is with costs going up, do you have the ability to raise the price? Now, I know the answer to that, but I'll ask it, with you on, I thought it would be useful to have your answer.
No, our hands are tied.
Yeah, absolutely. And that is the answer. No, it's a fixed price.
We wouldn't be making many friends if we tried.
No, absolutely not. And we've also got a question, George. There's another anonymous attendee. I don't know why we can't see the names. We can normally see the names. Would I be better buying a completed unit now or buying off plan?
It depends, I'd say. What are your requirements? Are you looking for yield straight away? What's your cash flow? How much money have you got available now? Do you want maybe a bit more certainty on your mortgage? Or would you rather buy off plan, 2 years, spread your cash flow out, and look at some very positive upside, which what I firmly believe you will get over the next 2.5 years as inflation and constrained supply, and significant demand continues to drive up capital values. So it's horses for courses, I would say. Yeah. It really depends on what the individual is trying to achieve, and is there funds available now? Do they want something that's yielding straight away, or is their cash flow maybe a bit more constrained?
Yeah, I mean, I think it comes down to what's your cash availability at the moment. Do you want to take advantage of if you've got enough to put in 35%, or what, then buy something ready. If it's if you want to accumulate capital, or you don't have that cash flow now, buy off plan. We've also got a question related to, I'm just very aware of time here. We've also got a question related to, which I think we've sort of answered, but again, just to address it directly. With the situation in Russia, with inevitably therefore less Russia, can't speak suddenly, with fewer Russia buyers coming into the market and a general global slowdown, what do you think the effect will be on investments into new builds? I mean, obviously, I know you probably partly answered that with the fact that because it's related to that sort of the fact that there is less new builds coming to market. But what's your sort of take on that?
Personally, in the markets that we are in, I've never seen much Russian or Eastern Bloc huge interest. If you read about Russian and those locations flooding money into the UK, it's usually high-end premium stuff, which is not really what we're involved in at all. I think the big drivers of our markets from overseas are the Asian investors, the African investors, certainly US money coming over. And, I used to work in sort of private equity and funds, so I know that market extremely well. And they are all, with the pound being where it is, their money will be coming over massively, but they'll be buying entire blocks of 100 to 200 to 300 units, not individual blocks, but them flooding the market, buying entire institutional blocks, which is similar to this. They will most certainly drive the rental market, but usually the capital, as I said before, because of their maintenance and things of residential apartments being better than your average buy-to-let, they also uphold capital value by doing so. So coming back to the Russian effect, I don't think that's going to affect attraction, apart from it limiting supply indirectly because it makes building harder. But as far as actual competition of sales, I think the sales has always been more Asia and for Africa's and America anyway.
Yeah. No, very good. Well, I'm aware we've been going for 51 minutes now, so I think we should probably look at wrapping this up. Just very quickly, you've mentioned the Ashford development already a couple of times. This is under construction, due to complete sort of early-ish next year. And again, from our perspective, George, one of our favourites. We've worked on my hometown as well, so it's although it's safe to say Ashford today is different to Ashford in the 90s when I experienced it. But the point is, again, another market that is being, where rents are being driven up, values have gone up already. It's another success story which we look forward to kind of renting out next year on handover. I think, unless there's anything to add, gentlemen, anything else you'd like to say before we wrap up? I mean, from my side, it just remains to say thank you very much to everybody who has taken 52 minutes out of their day to listen to us waffle on. I really do appreciate that. I hope you found it useful. Here at the RPA Group, we have representation all over the world, and would be absolutely delighted to speak to anybody on a one-on-one. I think what's very important, particularly to remember if you are looking to invest, whether that's in an interest rate environment we had a couple of years ago, or whether that's an interest rate environment today, the point is any investment needs to be right for you as the buyer, and it needs to be the right thing, to fit your budget, to fit the goals that you're looking to do. And so what I would absolutely urge everyone to do, if they are interested, is to reach out, have a conversation with one of our guys. We can help. We can give you some independent advice, and ultimately, if we can help, we would absolutely love to. Nick, thank you very much for joining. I appreciate you taking
Richard.
the time.
Take the opportunity to thank all the investors and everything who has supported us. It means a lot for our business work. So appreciate that.
Absolutely, and likewise. And George, thanks very much for your time. And we will talk again soon. Thank you, everybody. Very much appreciated.